live. It is Cowboy Metals live stream on 𝙂𝙊𝙇𝙀𝙍. We are Tuesday, December 7th, 2021 at 5 p.m. Central Time. Welcome everybody to the stream. We're going to give it just a few minutes to let everyone load and to let YouTube know we are live and in color. Welcome everybody into the live stream. Hope everybody is having a good week. We're getting close to Christmas. Looking forward to that. I know the family is looking forward to that as well. So good to see everybody. Those that support us on Patreon, we had our hour-and-a-half private Zoom call last night where we had a lot of good engagement. A lot of people came. We talked the mining stocks. We talked what's going on in the economy. We talked about where we think we're going to be at the end of this year and in next year, and gold and silver. Lots of good topics there. Lots of people joining us last night. Those of you who may be interested in doing a live call with me every month, if you join Patreon, the benefits are listed at patreon.com/goldsilverpros and support us there. You will get access to that live call. Once again, this is Cowboy Metals live stream. We broadcast from the great state of Texas, and we don't take any bullshit. And I wanted to do a special edition tonight to talk about an interesting headline I saw today in the news. And again, we'll get into that content as the stream loads and people get in here. Remember, super chats are open. If you guys are interested in that, or you can just ask your questions in chat. This will be a live Q&A as well, so we want to hear from you. The topic of today's video, I read this article on Zero Hedge and I fell out of my chair. It's one thing that I didn't realize was happening, but makes sense. A lot of the hedge funds are locking up their client money for years in their new deals. And their clients are looking for more alpha, meaning they're looking for return. Alpha is a stock term for getting return back and getting more return than average or above average return. And they're looking for that, and they're willing to risk their money for longer periods of time. And we're going to talk about some of the companies, the hedge funds that are doing this. What is the chance that all their money is going to be there in 5 years after we have the next stock market correction? We'll see. I don't think it's a great chance, but we'll get into that in a minute. Hello, everybody, for joining the program. Glad to see everybody here. Neil Hanna's in the house. My moderator extraordinaire, Michael Sayers, in the house. Thank you so much for joining, Michael. Ralph Potts, one of our most dedicated listeners, Patreon supporters, there for everything that we do at our conferences. Thank you so much for joining us. Henrik, I hope I'm saying this name correctly. Henrik 𝙎𝙊𝙇𝙬𝙊𝙎 from Sweden. Please tell me if I said your name even remotely correctly. Peter Frohwein is in the house. Very special guest from Arcadia Economics, 𝙎𝙄𝙀𝙊𝙎 is in the house. So happy to have you in the program. It's great when Yara joins. It brings me so much joy. Thank you, everybody, for joining in. We're still waiting for people to load. Again, we're going to be talking about hedge funds locking up client money for years. Give it a few minutes while people get in, and we will get there here pretty soon. Appreciate everybody being in the live stream. Difference between the Fed policy and the ECB, which we'll get here in a moment as we get more people in. We're up to 50 viewers. Doing great. Welcome, everybody. Welcome, everybody. All right. I'm looking up some information as we wait. Gigi is here. 𝙄𝙄𝙇 Games is in the house. Happen to check my feed while eating. How you doing, 𝙄𝙄𝙇? Is it a little bit late where you are? It's got to be like 2 in the morning where you are. Thanks for joining us. Good to see you here. Good that we could have something early enough that you could join. I know we don't get to see you every time, but welcome to you. Timothy Zub is here. Hey, Ralph, how you doing, buddy? Harold Torres is here. Everybody is here. Good to see. Gonna pull up something from gold. This time is different. I want to talk about it. But first, we got to get in the news, guys. Astounding headline, hedge funds locking up client money for years. So I'm going to do a share, and I'm going to show you this goofy article I found on Zero Hedge and what's actually going on behind the scenes. And I'm going to show you why that's risky. So let's get in first, right here on Zero Hedge. Goodbye liquidity. Clients agree to unprecedented multi-year lockups to keep money at Citadel and Millennium. And it's not just these two companies. We're going to start there. So here's these two paragraphs I'm going to read to you from this article. And we're going to talk about what this could mean. Multi-strat giants Millennium and Citadel. Starting with the former, that's Millennium, Bloomberg reports that Issy Englander's $57 billion hedge fund told investors last month that it had raised a record $10 billion for a fund that takes a minimum of 5 years to exit. That means if you send in your redemption notice now, you may get your money sometime in 2026 if you are lucky. That's right. You have the wonderful opportunity during this overvalued stock market of putting your money in and having to have it there for 10 years without being able to get it out no matter what happens. Doesn't that just sound like the best investment ever? Ken Griffin's $43 billion Citadel also updated its liquidity terms this year for all investors, reverting to a formula that under certain circumstances limits quarterly withdrawals to 6.25%, meaning it would take 4 years to fully pull it out unless the client is willing to pay a fee. So if you want to get your money, you got to pay a fee. Citadel's funds are currently closed to new investors, so if one quits, returning later can be difficult. Can you guys believe what is going on here? This is so silly. Remember, super chats are open if you guys are interested, or ask me questions in the chat box. We'll get to it. This is a live Q&A. So it goes on to talk about liquidity leverage. As such, some of these funds are extremely sensitive to any change in underlying liquidity. As a reminder, the repo crisis of 29 was a result of repo funding stress at the world's biggest, guess what? Hedge funds. As such, it is easy to grasp why these extremely leveraged hedge funds will do everything in their power to avoid a run on the fund during terms of market stress, which could lead to overnight collapse of the fund if it takes place during the market crash. So in other words, they're highly levered, and now they're creating schemes which force you basically to keep your money in from 4 to 5 years. Now, if you go down further in this article, it's not just Citadel Millennium. Veritone is doing it too. You can only withdraw 8% per quarter, meaning the rest gets left in there. Okay, think about it this way. Think about, you take your money to the bank. So you put $10,000 in the bank. You want $1,000 bucks, 10% to draw out, maybe to put a down payment on a house, or buying a car for your kids, whatever the case may be. And they say, no, you can only take 833 bucks. You have to wait till next quarter to get the rest of your money. What would happen to the banking system? People would run that banking system so damn fast because they wouldn't believe in liquidity if you can't get your money out. But these hedge funds are like, yeah, we're not your bank account. You want alpha, you want return. Okay, here's our terms. Schonfeld, 8.33% per quarter. Hudson Bay is only 6.5% a quarter. And they charge you 1.75% and 20% on it for the privilege of getting your money back out of these highly risky investments. What do you guys think about that? Does that sound like to you just such a great idea? Stick your money in these risky investments, bet it all on black, baby, for these stupid hedge funds, which, I'm going to show you the over leveraged stock market here in a minute. You guys are going to see how bad this is. It's ridiculous. But the hedge funds are desperate because they're levered. It's risk on environment right now. They know it. I don't think the people that actually run these hedge funds that understand the risk models actually believe they're going to be able to give all their clients money back. I don't. I flat out don't. I'm calling them out on this. But let's go to a special presentation I gave on the OTC market at the beginning of November. That's right. I gave a keynote presentation on the OTC markets in front of a bunch of investors and hedge fund managers and company executives, a lot of other people. Let's talk about that presentation. So this is a presentation I gave, gold and silver. This time is different. And I want to talk to you why at this particular point in history, you do not want to put your money into an over-levered hedge fund investing in stocks and other crap like that. So let's talk about P&E ratios. So there's something called the cyclically adjusted P&E, or the CAPE. And P&E is price to earnings, meaning how much does a company earn? How much are you paying? The higher that number is, you're paying more per dollar earned, meaning you're getting less return on your investment, less return on your capital overall. So the higher the P&E, the less desirable that investment is to an investor. So here we have the S&P over 10, or the CAPE, which is put together. It's put together by Benjamin Graham, David Dodd, and Robert Shiller. They popularized it, and they took the data all the way back to 1871. And they said what this allows us to do is determine how overvalued to the mean over time across different periods that stock market is. It takes into account a rolling 10-year average so that you can compare apples to apples for every 10-year period, right? So all of that basically means if once you get to a certain point, they basically figured out this bad boy's going to crash. And here are some of the statistics on that. If you just look at straight P&E, not over 10-year average, we're 178% above regression. Or what that means is you're 178% over the time average, 178% overvalued to what it should be across time, dating back to 1870. Okay, this is 150 years of data. This is pretty damn good indicator that goes a long way back. But if you take the PE10 and you average it over 10 years to get where you can compare 10-year to 10-year, we're sitting at the second highest level in history. Yes, that's higher than before the Great Depression. It's only eclipsed by the tech crisis. It is higher than what we had during the financial crash, the mortgage crisis. We didn't have an overvalued stock market back then, but during the tech crash, we did. Guess what happened during the tech crash? It was pain for several years for investors, especially those in the tech stocks. It crashed. We're at the second highest level. We're 80% above. We're at the end or the top of the fourth quintile being 20% or 1/5 of this percentage, right? In other words, we're 1 point away from getting to that last quintile. Well, studies show when you get to that last quintile, you get to 81% above mean over time on this ratio, you collapse. And not only do you collapse, you go all the way down through the mean and into the single digits. You're talking a 70 to 80% collapse of P&E ratios. No, I'm not joking. And this is when the hedge funds are saying, hey, invest and lock it up for 5 years when we're sitting at the second most overvalued stock market in fucking human history, at least in the US in the last 150 years. Okay. So here's the standard deviation. So we're going to look at it from a standard deviation perspective. What is standard deviation? Standard deviation tells you how far away you are from that mean. The farther you are away, the bigger of an extreme you are. Okay. We're sitting from its arithmetic mean at 117%, the second highest valuation using statistical standard deviation right here. We're here right now. This is where we were in the tech crash. Again, you see the theme repeating. The second highest P&E CAPE ratio dating back to 1870, higher than the Great Depression, higher than the mortgage crisis, higher than the inflation episode we had the 70s, 80s, second only the tech crash. Now let's look at it by percentile. We're at 98.4% here. The only thing higher was the tech bubble, but we're in tech bubble territory. You can see the orange here is tech bubble. We're smack dab in the middle of the tech bubble. We're almost where we were during the tech bubble when that thing crashed. We're above the 1929 peak. It's right here in green. Okay, that was before the big daddy stock market crash before the Great Depression. We're before the 2007 peak. Okay, we're here. We're above all that. Okay, ladies and gentlemen, it doesn't really get any worse than that in terms of overvaluation. So here we are in the second most overvalued market, stock market, when we're looking at price to earnings, when you're paying more for what you're actually getting out of it, at a time in which all of these companies are locking you in for 4 to 5 years with limits on what you can get out. And if you get out, you pay an absolute crap ton of fees. And why do you pay those fees? Because if you take their liquidity out, they're so highly levered, they need those fees basically to survive. This is absolute ludicrousness. It is absolute bonker zone. It is stupid. It is dumb. If you're passive investing, if you're in your 401k or pension, or if you're stupid enough to give these hedge fund your managers during this type of overvaluation of the stock market, you're asking for absolute pain. Pain. Hey, Cool Breeze, thanks for dropping by. Appreciate you. Both my moderators in the chat. Love to see both of you here. Juan Crespo is in the house. Fat Vegan is here. We have 1P4G, Peter Froing, Kenneth Martin, Stack Attack 999, Fine, Cosmo, Anthony. Hello, everybody is in the house. Thank you, everybody, for joining. I wanted to point this out, and I wanted to do a live stream today because, you know, again, this Cowboys Metal broadcast from great state of Texas, take no bullshit. This is the biggest load of bullshit I have seen in a long time. It's horrible. I got more for you guys. I'm going to sit here and chat with you guys for a minute, and then I'm going to tell you where the ECB and the Fed are diverging on policy. And I got a really stupid video from Christine Lagarde, the president of the ECB, and her describing inflation. You guys have got to see this video. I got to give credit to Ronald Storfley who put out this video. It's wonderful. He's over there in Europe. He caught it. And my goodness, wait till you see Christine Lagarde and her describing inflation. You know, when I posted that video of, I'm not going to talk about it. It was horrible. All right. Dumb Money Media came in with the contribution. Thank you so much, Dumb Money Media. I appreciate you making a contribution. Fat Vegan also. I'll start with Fat Vegan. He says, Zimbabwe and many other countries, right before hyperinflation, gold and silver plummet in nominal value. Please explain how this might have happened and why. Because right before hyperinflation, you have panic because you have high inflation as the people are selling a lot of things. They're panicking, trying to liquidate. And what they do is they liquidate gold and silver along with furniture, along with stocks and real estate to get cash position because they may have debts or they may, need to buy food and stuff like that. When you have persistent high inflation, people get to panic and they'll liquidate literally everything. And it will a lot of times drive down the precious metals prices if they have it. They may be throwing jewelry at their jeweler. I mean, whatever you have, the family silver candlesticks, whatever the case may be. And so be a temporary pullback. Now, when the stuff hits the fan, you get to hyperinflation, then people are like, oh, forget the money. They go the opposite direction. They go to whatever has value. It's just normal human behavior because think about it. If you've got debts and you got to pay them off, you need cash, right? So you're going to go to cash for a while until you figure out the cash is trash. And then you're going to go back and try to get everything else. It's normal human behavior. It's, that's why you'll see like the gold and silver stocks crash at the beginning of the stock market crash, and then they'll pop back up. People are liquidating, and then they realize, oh, wait, these things are going to be super valuable when gold and silver go up. Let's go back into them. And that's just, it's normal human behavior. You do the wrong thing at first, and then you do the right thing, I guess, is the best way to describe that. Dumb Money Media, the streamers I've had in so far really cool and interested in sound money. I plan on sending them the first 1 ounce of silver here soon. Thank you so much, Dumb Money Media. We want to talk about his channel. Let me see if I can get that channel up. Dumb Money Media has supported us for the longest time. So we're going to punch his channel up on YouTube and we're going to talk about his videos. And he's got a great channel. He's done meme videos. He's starting to do interviews and stuff like that. Let's get that up here on the screen. Here we go. Love him. He was at Silverfest. He did stuff for our conference. Schiller's Corner. He's got guys there. He's got meme videos. This is all Dumb Money Media on YouTube. Everybody go over there, please. He's building up his subscriber list. Big support of us in Arcadia Economics. Appreciate having him here with us. Thank you so much again, Dumb Money Media, for the contribution and for coming over to the program. Let's see if there are any additional questions in chat. Before I talk about the ridiculousness of Christine Lagarde, I should really give Christine Lagarde the clown. What do you think? Should I christen or crown my fourth market clown and give it to Christine Lagarde? I think I should, because after you see this video, I mean, you just have to call her a clown because I don't think she believes what she's saying and she's full of crap. All right. Real money is gold and silver, Peter Frohline says. I agree with you, my friend. Any other questions, please type them in. I love silver, says Neil Hahn. I agree with you, my friend. How do I sign up for the Hedge? You don't have to sign up for Zero Hedge. You just go to 𝙎𝙄𝙇𝙊𝙎.com. Now, there is a pay service on Zero Hedge if you want it, but they have a lot of free articles. I say if you just go with the free articles, you're good. 𝙎𝙄𝙇𝙊𝙎.com, 𝙎𝙄𝙇.com. Great site. I'm not buying silver. I'm dumping fiat, says Juan Crespo. That is a really good comment. Let's see. All right, I think we're good, guys. I think we're done with the questions. So we're going to get into our second topic of the day, which is the asinine comments by Christine Lagarde about inflation. You guys have to see it. It's extremely comical, silliness. And again, Ronnie Storflay, thank you so much. I'm going to share it. You guys got to listen to her explanation. I think she's going to be the fourth market clown. I got to crown her as a market clown. I got to do it. Listen to what she says.
An inflation profile, which looks like a hump. So it does clearly increased over the last 3 quarters. And we know how painful it is. We know that, life is more expensive as a result, particularly for those people who have low income and who are more exposed to prices rising, particularly when, you fill up the tank.
Okay, now we've had her and we had the vice president come out and say the same thing. The goofy video of our vice president over here in the US saying, well, you know, it's hard when people have to pay more for gas and bread. It's hard when inflation goes up. Yeah, tell us something we don't know, you stupid idiots. We want solutions. We don't want your asinine, stupid explanations of inflation. We're not kids. We're not children. All right, keep going. This is where it gets really stupid.
But we see it as a hump, and a hump eventually declines. And this is what we project for 22, that inflation will decline over the course of 22. An inflation profile, which looks like a hump. So it does clearly increased over the last.
It's a hump. Thank you so much, Christine Lagarde, for explaining inflation. It's a hump. It's just going to go up and it's going to go right back down. This is her not using the word transitory, but saying the same damn thing. It's not going to stick around. And the Fed and Powell have basically given up on that. They've given up on trying to fool people and say it's not transitory, okay, or it's transitory. They dropped it. So I'm going to show you an article here. Tons of articles on Powell saying we no longer expect to be transitory. Here's one I found in 3 minutes at CNBC. And it's talking about putting pressure on the ECB to be clear on inflation after Fed drops it. So this is a few days ago. And then what does she come on saying? Oh, it's a hump. It's transitory. This is just 5 days later. This is completely stupid. ECB faces calls to be clear on inflation after Fed's Powell drops transitory. Powell told U.S. lawmakers it's probably a good time to retire that word, transitory, and try to explain more clearly what we mean when talking about inflation. The latter has been a matter of growing concern within financial markets. Blah, 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 blah. And here's a picture of Christine Lagarde in this article. Faces calls to be clear on inflation. And this is what she says.
An inflation profile, which looks like a hump. So it does clearly increased over the last 3 quarters. And we know how painful it is. We know that, you know, life is more expensive as a result, particularly for those people who have low income and who are more exposed to prices rising, particularly when, you know, you fill up the tank. But we see it as a hump, and a hump eventually declines.
So first of all, what the hell does eventually mean? And aren't you saying it's transitory? Aren't you just basically trying the same shit that Powell tried in the US?
And this is what we project for 22. That inflation.
When in 2022? These central bankers are the ones that create the money supply. Why in the name of Zeus's fucking butthole can you not tell me when the inflation is going to decline when you guys are producing all the currency? I don't understand this. You guys are dumbasses. You're a clown. I'm sorry. You're a clown, Christine Lagarde. Either you're knowingly trying to lie to the public, you're misdirecting when the public is in pain because they're dealing with all this inflation. Or you're a flat out liar. I don't know which, but I think you're lying because I don't think you're a stupid lady. I don't think you get to your position if you're a dumbass. And I don't think you are. I think you're probably lying, or at least you have lost all sense of reality when it comes to currency. Oh my God, I almost lost my train of thought. I got so mad there. But I'm tired of these central bankers pulling this crap with the public. You guys are in positions of power. We entrust our currencies to you, you stupid idiots, and you try to clown us with this stuff, and we're tired of it. We're absolutely tired of it. Anyway, I had to call it out. That's why I put on the cowboy hat today. We're not taking bullshit today. I'm sorry. No bullshit today. What are your guys' comments? Throw them down there in the chat. We have another contribution from Dumb Money Media. I'll get to your question in a moment. Wow, 140 people in the chat. This is awesome going on. Thank you guys for joining. Lawrence Sawicki is in the house. 720. Okay, Dumb Money Media asked a question. What's the forecast for this Friday's consumer price index? I'm thinking 6.9, parallel on the mean 69. How high will it go before stocks start crashing for real? And the first guess was Lawrence Sawicki, who said 7.2 CPI on Friday. My guess, I'm going to say it's a lot higher in reality, but I think they're going to lie. And I think they're going to say something like 6.4, 6.5. I think they're going to game that number so it doesn't go up more than about a quarter to about a third of a point. I could be wrong. Maybe they want everybody to know that we have raging inflation. I think it's much higher than that, but I think they're going to keep it no higher than about 6.5. Could be wrong. Could be 6.9. Dumb Money Media could be correct. We will have to see. Yara says, I'm loving the no bullshit wearing hat, Rob. Thank you very much. I appreciate it. Sometimes you just got to get on and tell the truth. You can't fuck around. Yeah, they would lie to us, question mark, laugh out loud, says Peter Freund. That's exactly correct. Yeah, I just, it drives me nuts. These guys drive me nuts. Let's see. Ooh. I'm going to get, by the end of this video, I'm going to get Christine Lagarde into a clown get up. I will do it. And let me get a picture. I've got her. Save image, Lagarde. We're going to do it, guys. We are going to get save image as. We're going to do it. All right, I'm going to work on that. Put your comments in there. What do you think the CPI is going to be? And what about our first two articles? Hedge funds, locking up funds between 4 to 5 years of these guys, not allowing to pull it out when we know the stock market's the second highest all-time valuation, relatively speaking, using the PE10 CAPE. What about Powell's comments to retire the term transitory and Christine Lagarde trying to say, well, it's a hump. It's a hump, which is the exact same thing, one of the dumbest things I've ever heard. What about that? What are your guys' comments on that? Leave them down in the chat. Let's talk about it. I think it's absolute stupidity. I don't understand how they think we're going to listen to this stupidity. I just don't. How dumb do you think we are? And why do you keep saying it? It really, it doesn't make any sense to me. All right, here we go. I've got a picture. I'm really working on getting her in a clown suit. She's going to win the 4th clown award here. Let me get this up here, see if I can get it, and we'll see what they do. All right, I got her. Crop it, and let's see if we can get her in a clown. Here, I got it, guys. I got to show you this. This is Photo Funnia. This is so much fun. Christine Lagarde, you win the 4th clown award, courtesy of Gold Silver Pros. We're going to share screen on this. You guys are going to get a kick out of this. Here we are. There's Christine Lagarde in clown makeup. Thank you, Photo Funnia. You've won the 4th clown award, market clown award for Gold Silver Pros for trying to tell us that inflation is transitory when we just proved in the US it's not, and just simply using a different term like hump doesn't lend any credence to what you're doing. And for all the hedge fund managers, you guys are honorary clowns for this episode because you're clowning the market and thinking that they hold their money with you in 4 or 5 years in this overvalued P&E market, that they're going to have anything left. More garbage coming from people that want to take your money or want to fool you into thinking that your money actually has value. Thank you, everybody, for supporting us on this video. 150 people in the chat right now. Thank you so much. We did a little bit earlier today. I just saw the headlines and I told my team 5 p.m. today. I got to get on this early. I had a lot of energy on this one. It's more garbage from the central planners, and it's more garbage from the hedge fund managers in the market. 𝙂𝙊𝙇𝙍 is in. Joel Brinchley is in the house. Spiked Head Die Crack is in the house. Bubbleox is here. Thank you, everybody, for joining. If you have questions or things you want to talk about, please let us know in the chat and we'll talk about it. We have covered the hedge funds locking up client money in this overvalued market. We talked about Christine Lagarde winning the 4th market clown award from Gold Silver Pros for her call on inflation. What else do you guys want to talk about? There's a lot of news this week, guys. We got CPI coming up this week, a guess so far of 6.9, one of 7.2. What do you think it's going to be? OG Jen Bling singing the Humpty Hump song. I thought about that. There's another one for Black Eyed Peas, which is a hump song, but it was a little bit more explicit with Fergie singing that. It was great. It's a great video, and I thought about putting that on there. But anyway, I let you guys use your imagination on making fun of hump there. I actually posted something on Twitter earlier and I took it off. I thought it was better. Silver Tiger is here in the house. Dezo Games, talk about the 10-year. Okay, so we were talking last night on if you're a Patreon supporter, I did something special last night. Every month we do a 90-minute Zoom call with the highest tier of support, but I opened it up to everybody on Patreon. We have about 70 people supporting us on Patreon. Thank you guys so much for doing that. We did the 90-minute live Zoom call with me, and we were talking about the 2-year, 10-year Treasury yield curve. So what's happening when the yield curve inverts, and we'll talk about it in a minute. Let me get the chart up. When the yield curve inverts, it means shorter term bond issuances come with a higher interest rate because there's more risk than longer term, and that's abnormal. It's basically backwardation in the bond market. When you have shorter term rates higher than longer term, because longer term, you think about it, you know less about what's going on, there's more risk, right? And so typically you would have, and we're going to get this chart dating back. We're going to go max on this. Okay, so typically in the bond market, you'd have higher longer term rates. So higher rates on 10-year versus the 2-year. So we're talking about this, you know, on the call. And so I'm going to share with you this chart. So what happens is every time the 2-year rate gets higher than the 10-year, meaning they think that the shorter term market has more risk than the longer term, or basically bonds go in backwardation when comparing the 10 and 2-year, essentially what that is. You have a recession. I think 7 out of the last 8 times, or 6 out of the last 7 times, it's predicted a recession. So it touched on it right here in August of 2019. We had not a yield curve inversion, but a yield curve evening where the 2 and the 10-year were almost identical. It didn't quite invert, but it got real damn close. And I said that we're headed for a recession. We had a little baby recession, according to the Fed. And I think we're still in a recession, although officially they're saying we're not. And then it rebounded. And then everybody thought everything was good. We printed massive amounts of money in 2020. M1 went from 4 trillion to 20 trillion. They multiplied it by 5 in 1 freaking year. And that bailed everybody out and everything was good. So it went normal. 10-year went significantly higher rates than 2-year. Everything's normal, no worries. But then people started to realize that we're having inflation, first in commodities complex, then transmitted to the producers and the PPI, and then transmitted to all these high inflation prints that we're seeing in the CPI throughout the supply chain. And what's happening is we're starting to see closer to yield curve inversion again. The 2-year rates are rising respective of the 10-years, meaning that short-term money is getting more expensive. It puts pressure on the short-term bond market, and it indicates a recession, as you can see here on the chart. Every time it's inverted, or this number has gone below 0, okay, we've had recession, gone below 0, recession, gone below 0, recession, gone below 0, recession, gone below 0, recession, hit 0, mini recession, going back down toward a yield curve inversion, predicting a recession. Just like I told you earlier, the PE10 is predicting a stock market crash. The bond market is getting closer to predicting a recession. It's not there yet, but it's getting damn close. And it's been one of the most reliable indicators of, are you going to have a recession? So wanted to point that out. That was a good point brought up on our private Zoom call for the Patreon supporters. Cheshire Yemen says, damn, I miss Robin his cowboy hat. Yeah, I brought it back. It's a lot of fun. I don't get to wear it that often. Sometimes I wear it out. It's fun to wear it. You know, because we live in the great state of Texas. We got to have more cowboys. We need cowboys who operate with a code of honor, who protect their friends and their families, who do the right thing, who work hard every day, produce something that everybody can use. That's cowboy culture. That's Texas culture. And it still is in a large part of Texas. And we need to bring that more out. We got to do it. It's a good place for the world to be when the cowboys are strong. All right. Peter Frowen says, can we avoid the digital Fed coin? We need a crypto that is 4% gold backed that the Fed does not control. I will not be a Fed coin slave. Hell no! Exclamation points all over the place. I don't think we're going to avoid it because the dollar is going to crash and they're going to shove it down your throat. And they've got all the regulatory approvals to do it. They've been setting that up. Can you avoid it coming out? No. Can you avoid using that as your main currency? And can you do other things? Yeah, gold and silver, bartering, stuff like that. Yes. Are they going to shove it down our throats? Yeah. Can we not adopt it as much and put tremendous pressure on that as a society? Sure. Are they going to come out with it? Yes. Do we have to use it? Hell no, we don't. Any other questions in the chat? I'm going to go back and see. Oh, Lawrence Sawicki. So what happens in an inflationary recession? Those are some dark clouds. Maybe the hump can figure it out, right? The Humpty Hump can figure it out. It goes inflationary, then the inflation and the monetary supply inflation prices cause a deflationary collapse in GDP. Then the central bank prints, you have the crack up boom, then you have hyperinflation. That's the Austrian economics explanation for what happens. I happen to agree with it based on what I've seen in history, done in the media. How much worse does the US energy crisis need to get before we get new nuke plants? Is it strictly political for the reason not to have them right now? Yes, ESG wants to demonize uranium, even though it's the cleanest of any mineral-based fuel, and the most power per dollar invested, per dollar required. It's cheapest, and without uranium, without the nuclear, I mean, the US would be, God, it would be rolling blackouts all the time. I mean, the only alternatives are coal and natural gas, but you have a lot of coal, but people say it's dirty. They demonize that. Natural gas is cleaner than coal, not quite as nuclear, but it doesn't have the base load capability. Solar and wind are not reliable. I saw that in Texas during Snowmageddon earlier in February. We know it's not reliable for base load power, especially have weather situations. So what else are you going to do? Yes, it's political. It's very political. A lot of it has to do with the green movement. A lot of it has to do with misunderstanding. And yeah, it's an issue. 𝙂𝙃 contribution of £449. You must be somewhere in the United Kingdom. Welcome, our United Kingdom friends. And thank you so much, 𝙂𝙃, for the contribution. If you have a question, put it down there. I'll try to answer the best I can. Dude Boy says, let's go, Brandon. I agree. Neil Hahn says fusion. Yeah, but I think we're a ways away from that. But I think you're right. I think they're working on fusion. Peter Freund says the saying goes, don't fight the Fed, screw that, I'm going to fight them like hell. True Conspiracy says, bet on thorium liquid salt reactors as a new tech. Yeah, I covered that on Seeking Alpha, thorium liquid salt reactors, how safe it was, how prevalent thorium is, how cheap it would be, how you could do modular and do from small to big. There's no nuclear meltdown with that liquid salt system. 𝙂𝙃, I think, is the company that was put together from a former NASA guy that was examining that. I wrote a big article on that 7 or 8 years ago on Seeking Alpha. I agree with you, True Conspiracies. That is an option, but they don't want to finance it because thorium can't be weaponized as easy. I don't even know if it can be weaponized at all, but uranium can. And that's why they're supporting the uranium market, baby, because you can build nukes with it. Gravity batteries plus solar and wind, otherwise no way to store it. Blaine N says, what's the reasoning for miners constantly changing names? Sometimes they need a fresh approach to the market. What happens in the mining sector, without spending too long on this, people get down on it, change of management, new exploration. You know, you got to have some zoom factor in there. You got to have some punch to get people interested in you. Again, if you come with a 10-year-old name and you're redeveloping a project, maybe, you know, the investor's money isn't there. So they put a fresh face on it and they, you know, dress it up and hopefully do some additional due diligence, put out an updated 43-101, and away you go. And I think that's what happens. A lot of times also it's mergers and acquisition activity. You know, there was a report of a popular company I've covered having a big announcement today where they did a merger. I'm not going to announce it yet. We're going to do that later. But they did a merger with another project and they haven't changed their name, but they could, because now it's two big projects in the same district. And it would make sense for them to release a new name. It's a different proposition for the investors, a bigger and better proposition. Sometimes they'll do it for that reason. Hopefully I answered your question. Line in the Sand Ministries. Do you ever look at the economic state of our country through the lens of a biblical worldview? Yeah, but I don't do it on YouTube because either religion or politics tends to inflame the censors on YouTube and also tends to get people yelling at each other. And at the end of the day, I'm here to draw common ground. So I'm not against it. I'm a Christian, but I just don't bring that flavor to the channel for that reason. So, you know, if you want to do it, hey, freedom of assembly, baby, it's in the Bill of Rights. Go ahead and do it. I don't do it on these public airwaves just for various reasons. But I got no problem if you want to talk about it. I don't see any other questions. Oh, is the tech ready at Neil Hahn? I don't know if you're referring to the 𝙂𝙃 technology. Oh, fission fusion reactors. I don't know. I don't think fission or fusion are either one ready to answer that question. It wasn't for me. The Groovy Jones question. The hedge fund thing looks like another symptom of tightening in the markets. Are there any institutions doing anything signaling enough liquidity? I think the reverse repos indicated there was too much liquidity in the short end of the market, the short paper. And I think because the Fed just flooded the market and then people were using it to basically arbitrage the overnight lending rate that they could park at the Fed. And so I think it was an arbitrage play for participants. But that's the reverse. It's excess liquidity on that end of the market that needs to be drained out. But all it takes is a crisis to drain that out really fast. Let's see. Any news on reverse repo? I haven't found anything lately. It hasn't been as much in the news. It was very highly liquid there for a while, which is an indication it's an indication that people are searching for returns. When you throw that much repo paper in there, they're searching for returns. Will the manipulation ever end? If you're talking precious metals, yes, it has to, mathematically speaking. When? It just depends on when people wake up. Think about the manipulation of precious metals ending when people flock to them because they realize everything else is crap, or at least all the other paper is crap. It's the same as when you have a currency crisis. When they have a crisis of confidence in the currency, it hyperinflates. And then they'll go to the precious metals and boom, that'll break the manipulation. When you have mom and your taxi driver and everybody talking gold and silver, it'll break that manipulation. The manipulation is very fragile. It's not absolute at all. You can see it in the data. Is it good to have a tractor for the next hyperinflation? We talked about this also on the private Zoom call for Patreon supporters last night. We talked about how you could survive, currency crisis, economic collapse. We talked about having farmland and developing that food supplies for people. Yes, it would make you incredibly rich. Farmers can do very well in currency crisis if they're prepared. And I won't get any more into that, but yeah, having a tractor could be a good thing. Anything productive that you do, fixing people's cars, helping people with their technology, growing food, shelter services, anything that people can afford to pay for. Knowing how to get stuff like a fixer or just somebody that knows people, like a networker, can, when I talked to Fernando Aguirre about the Argentinian peso crisis, having somebody who knew how to get stuff, and I'm talking legally, I'm not talking black market or anything or illicit stuff like drugs. I'm talking like just getting stuff people need, like baby formula, can be incredible. Last question I'm going to answer, guys. I've been going strong for about 42 minutes. Line in the same ministries. Do you feel the whales are moving out of their positions in crypto one at a time, hyping and then letting another? And yeah, the basic, and 𝙄𝙄𝙊𝙇𝙄𝙊𝙎 here, and he can answer that better than I can. What you see is washing transaction from big guys up. They build up the price and then they sell out to a bunch of smaller guys. 𝙄𝙄𝙊 had a really cool website the last time he was on our channel talking cryptos. It was probably 3 or 4 months ago where he talked about it. And you could graphically see it. You could see that the big guys washing it up. And of course, the big guys are mining it. So where do you think they get it? They mine it, then they wash it up against each other, build a fervor. They have all these guys go out and pump crypto on all social media and everywhere. And then they dump it on the market to the little guys after they've done that. And the little guys take the losses. And it's basically just a repeating pattern. It's a typical Ponzi, but they do control the supply of the actual Bitcoin because they're the big miners that are involved in that and selling out. So I think that's what happens based upon the data. All right, that's going to do it today, guys. I'm going to recap. We peaked at about 160 people in chat. That's awesome for a last minute 5 p.m. impromptu live stream, Cowboy Metals broadcast from the great state of Texas, where we take no bullshit. We gave our 4th Market Clown Award to Christine Lagarde, talking about inflation being transitory, but using other language, trying to fool people. We're not stupid. We talked about the hedge funds, and essentially what they're doing is locking investor big money in for 4 to 5 years, or really strict redemption requirements and fees at a time when the stock market is the second most overvalued from a P to E ratio in history. Okay, in history. And a lot of people are going to get hurt there. We talked about that garbage. We talked about a lot of other things. This has been a great live stream, guys. I've enjoyed it. I am going to get a bite to eat here in a moment. Want to wish everybody a happy week. We have the holidays coming up. We're going to do some special stuff for you for the holidays. I'm going to try to do a couple more live streams and maybe another roundtable or 2. And then we're going to be a little bit quiet right over Christmas. And then we'll come back after. We hope you guys enjoy your holidays. Hope you enjoyed your Thanksgiving. Love to see you guys here. Appreciate everyone that supports us on Patreon. Remember, patreon.com/gold silver pros helps us do all the stuff we do, and you guys get special content. Thank you for all the people that come every day and support the program. We will see you guys. We have a special update for you guys tomorrow, Wednesday, December 8th, from our super fan and channel moderator, Steve Mueller, the dissident dentist, is going to give us an update on uranium. You guys, if you're into uranium, stay tuned to that. Lots of great data, great update, fun video, a couple of friends shooting the breeze on uranium. I think you guys will like that. We put it on Patreon first for our supporters last week. It's going to be on the channel tomorrow. And then Thursday, we got another roundtable for you. I'm not going to tell you who's in the roundtable. You'll have to drop by the channel to see, but I think you're going to like this one. That's going to be a lot of fun. All right, guys, this is going to do it for this edition of Cowboy Metals Live. We appreciate everyone. We will see you next time.